Hello and welcome to another session of the My Solo 401k Financial Daily Webinar Series. We're excited to discuss today real-world examples, mega backdoor Roth solo 401k strategies for your side gig. As always, the presentation is being provided for educational purposes only and should not be construed as tax, legal, or investment advice, nor as a solicitation. When making an investment decision, please consult with your tax attorney and financial professional. If you are on YouTube or LinkedIn or Twitter, please subscribe. That'll help us get the word out to other entrepreneurs just like you. And that'll also get you notification of when we go live so you can join the conversation. So before we get into the examples of mega backdoor Roth solo 401k strategies for your side gig, let's first lay the foundation with what is a solo 401k, who's eligible to set up a solo 401k. So a solo 401k is a 401k plan for a self-employed individual. So you got to be self-employed. That's what is one of the key components of being eligible. So it's for an owner-only business with no full-time W-2 employees. So think like an independent contractor, a solo practicing professional, could be a CPA, could be an attorney, could be a realtor. The key is that you don't have any employees working for you other than of course yourself or your spouse. So no non-owner, non-spouse, full-time W-2 employees. Now, some of the top eligibility considerations are going to be, okay, do I need a separate entity? The answer is no. You have many customers, for example, who operate as sole proprietors. You don't need to have a formal legal entity. Of course, if you do, that's fine also. In that case, your entity, such as your LLC or your S corporation, that'll be the entity that sponsors the plan. Ultimately, what's most important is that you report earned self-employment income. For example, if you are operating as a sole proprietor, earned self-employment income is going to be income reported on Schedule C of your taxes. If your business is taxed as an S Corp, it would be W-2 wages from the S Corp. There's no minimum amount of earned self-employment income that's needed to report to be eligible. So it's not just for bigger businesses. It could be for a micro business and you'd still be eligible to set up a plan. Again, as long as you're reporting that earned self-employment income with no employees working for any business owned by you or a spouse, if any. Now, your spouse or business partner, they may also participate in the solo 401k. So in order for them to be eligible to participate, they would need to be working in the business and reporting their own earned self-employment income. So if your spouse is going to participate, your spouse would get their own Schedule C, or their spouse would also receive their own W-2. You can have a solo 401k even if you have a W-2 job, even if you participate in your W-2 employer sponsor plan. So that's super relevant for this session where we talk about real world mega backdoor Roth solo 401k strategies for your side gig, because side gig implies that you've got a day job. So you say work at a company, you even participate in your company's 401k, but you've got this other self-employment activity with no employees working for you. You could set up a solo 401k for that self-employment activity. Now, for those that are eligible and that sign up with us, one of the top reasons that they sign up with us is the ability to make mega backdoor Roth contributions. So like any Roth contributions, the advantage is that you got the potential for tax-free growth. So for example, you put money in, you contribute money to the plan on an after-tax basis, but then the growth is potentially tax-free. So that ultimately when you withdraw the money, all those subsequent gains are tax-free. Now with the mega backdoor Roth solo 401k, the advantage is that you're able to contribute potentially much more to the plan. So for example, for 2025, you could contribute up to $70,000 if you got the self-employment income to justify it, or $77,500 if you're age 50 or older, or $81,250 if you're age 60 to 63. if you're self-employed, you have the income to justify it, and you have a plan like ours that allows for the mega backdoor Roth. So the key is that you got to be eligible, number one. And then number two, you've got to work with a solo 401k provider that offers a plan that allows for mega backdoor Roth solo 401k contributions. Now, mega backdoor Roth solo 401k contributions is more of a marketing term. Really, what one is doing when they're making mega backdoor Roth solo 401k contributions is a two-step process, because they're first making what are called voluntary after-tax contributions. So you have to have a plan that allows for voluntary after-tax contributions. That's step one. And then they're transferring those funds either to a Roth solo 401k or to a Roth IRA. So you also have to have a plan, meaning the documents, the 401k documents, that not only allows for voluntary after-tax contributions, but also allows for that second step, the in-service distributions. And then, of course, it's going to be prudent to work with a company like us that has deep experience in helping customers through those required steps. So, for example, when you make the voluntary after-tax contribution, it needs to go into a separate voluntary after-tax account, step one, before it gets moved to a Roth solo 401k or Roth IRA, step two. Now, that first step, the contribution, that doesn't need to be reported on the personal tax return or the business tax return, right? It's being made on an after-tax basis. But the second step, when you move the money from the after-tax account to either the Roth solo 401k or Roth IRA, that is reportable. It's reportable by the plan on a 1099-R. Now, we handle that 1099-R as an optional free service for our customers. In other words, no additional charge. Customers just have to let us know so we can capture the information we need to prepare the 1099-R. Now, excuse me, in order for us to understand these real-world examples of making mega backdoor Roth contributions for a side gig, we first want to understand, okay, how much can I contribute, right? You got to understand the contribution rules generally. So to understand how much I can contribute, it's going to be good to understand that there are different factors that go into how much I can contribute. For example, one principle is you can't save more than you earn, right? So you're going to be limited by your self-employment income. That's what we mean when we say you have to have the income to justify the contribution. Another factor is your age, right? In the earlier slides, we were talking about how the contribution limit goes up once you're age 50 or older. Another factor is going to be, do you make contributions to another plan, right? Do you participate in another retirement plan, like a 401k plan through a day job? And then the type of contribution that you want to make, right? Whether it's employee versus employer, pre-tax, Roth, or after-tax, because each of those different subtypes has their own limit. Now, today's session, we're focusing on businesses that are taxed as a partnership. If you go to our YouTube channel, you see, for example, recently in our history that we had other of these parallel type of presentations that were focused on businesses taxed as an S Corp or businesses taxed as a sole prop. So if you subscribe, you get notifications, you can access the history. For a business that's taxed as a partnership, when we talk about, okay, how much can I contribute? It's limited by my self-employment income. What does that mean when my business is taxed as a partnership? Well, for a business taxed as a partnership, you got to run a pre-calculation where you take your self-employment income reported on line 14 of your K-1 and then reduce that amount by 1/2 of the self-employment tax. So you got to run a pre-calculation. Of course, you can't consider W-2 wages from other sources like a day job. You can't consider investment income, right? The whole purpose of the solo 401k is for people to save earned self-employment income. So not investment income, not income from a job, but earned self-employment income for retirement. So this is a good slide as it shows visually that pre-calculation of line 14 of the K1 less 1/2 of the self-employment tax. Now, as I mentioned, there's, your ability to contribute is going to depend on the type of contribution, but you've also got to consider the overall limit. So different types of contributions will have their own sublimits, but then of course there's the overall limit. For 2025, the overall limit increased from 69,000 to 70,000. The catch-up contribution for those age 50 or older stayed the same at 7,500, but now they've added a new super catch-up contribution limit, which instead of $7,500, now those age 60 to 63 can contribute $11,250 as a catch-up contribution, or really a super catch-up contribution, assuming they've got the self-employment income to justify it. Now, we now know based on this conversation that when you make a mega backdoor Roth contribution, you're really making a voluntary after-tax contribution and then an in-plan conversion or transfer, either to a Roth solo 401k or Roth IRA. So that means when we talk about how much can I contribute, we need to know, okay, well, what are the voluntary after-tax contribution limits, right? Remember we said, depending on the type of contribution, each type is going to have their own sublimit. So in terms of the voluntary after-tax contribution limit, that limit is the lesser of self-employment compensation and the overall limit, right? For 2024, it's $69,000. For 2025, it's $70,000. Now, you still need to consider the overall limit. So that's what we mean when we say that that's reduced by any other contributions made to the plan, like any employee or any employer. However, if you are age 50 or older and you're making a catch-up contribution and you make it to the solo 401k, that's not going to reduce how much you can contribute as a voluntary after-tax contribution. So stated differently, once you're age 50 or older, that voluntary after-tax contribution doesn't go up. So instead, you have to make that catch-up contribution either as a pre-tax or a Roth employee contribution, but you also don't have to count that catch-up contribution when you're determining whether you've met the overall limit. So ultimately, you're still going to be able to contribute those higher amounts because of the catch-up contribution. It's just that you wouldn't make that catch-up contribution as an after-tax contribution. You either make it as a pre-tax or a Roth salary deferral, or what they call employee contribution. Now, if you do make contributions to another plan, like a day job plan, that's not going to reduce your ability to make after-tax contributions. In other words, that after-tax contribution limit applies at the plan level. So it's not reduced by contributions made to another plan sponsored by an unrelated employer, like a day job plan. Now, the one exception to that rule that you don't have to aggregate contributions made to another plan sponsored by an unrelated employer is the 403B exception. So all contributions made to the 403B, whether employee, employer, together with any contributions that you want to make to the solo 401k, the sum of those two amounts can't exceed the overall limit. And then lastly, we like to remind that those voluntary after-tax contributions do need to go into a separate sub-account. This is how you end up with 3 accounts, right? Because you got pre-tax contributions, Roth contributions, and then a third account for after-tax contributions. So now that we've laid the foundation with that good foundational knowledge as far as the contribution rules, et cetera, let's start to apply those rules to different scenarios. So let's presume we've got a self-employed business, taxed as a partnership, could be a multi-member LLC, taxed as a partnership. And this self-employed individual is under age 50. Let's assume that this person maxes out contributions to their day job plan. Because remember, we're talking about real world mega backdoor Roth solo 401k strategies for your side gig. So that implies you've got a day job. And let's say you maxed out your contributions to your day job. Let's assume you put in $23,500 for 2025. But your goal now is to maximize Roth and or voluntary after-tax contributions to the solo 401k. Let's assume that you have $100,000 of self-employment compensation. In other words, after you take line 14 of your K1, less 1/2 of the self-employment tax, The product of that pre-calculation is $100,000. So how much can you contribute to the solo 401k? Well, you can't make any employee contributions because remember, you maxed out those contributions to your day job plan. You're not interested in making pre-tax employer contributions, so you just skip making employer pre-tax contributions to the solo 401k. So that means you make 100% of your contributions, which is 100% of your self-employment compensation, dollar for dollar, up to the overall limit as an after-tax contribution. You first put that into the after-tax account before you move it over to the Roth solo 401k or Roth IRA. You got the choice. So for 2024, that means you're contributing $69,000. For 2025, you're contributing $70,000. So now let's change the scenario. Let's assume that the same person, except that this person is now 50 or older. Let's assume that this person continues to maxes out contributions to their day job plan. So they're making that catch-up contribution, that $7,500 catch-up contribution to the day job plan. And they're still only interested in making Roth or mega backdoor Roth contributions to the solo 401k. So in terms of the employee bucket, they've already filled it up to their day job plan. That employee contribution limit applies at the employee level. Once they've filled it up to the day job plan, they can't make any more employee contributions to the solo 401k. Again, they're not interested in making pre-tax contributions, so they'll just skip making employer pre-tax contributions, and they'll contribute 100% of their self-employment compensation, dollar for dollar, up to the overall limit as an after-tax contribution, and then move it either to a Roth solo 401k or Roth IRA, so they got that potential for tax-free growth. That's $69,000 for 2024, $70,000 for 2025. So let's keep going. Let's change the scenario again. Now we're being back to under age 50, but let's assume that there's two participants. So we got a husband and wife. Now each person is maxing out contributions to their day job plan. Each person has $100,000 of self-employment compensation, right? Line 14 of K1, less 1/2 of the self-employment tax. And each person, each spouse is only interested in making Roth or voluntary after-tax contributions. So how do the limits change? What are the limits for each person? Well, again, each person's maxed out their contributions, their employee contributions to their day job plan. That employee limit applies at the employee level. They can't make any more employee contributions to the solo 401k. Neither of them are interested in pre-tax contributions. They're only interested in making Roth and mega backdoor Roth contributions. So they just decline to make employer pre-tax contributions. And since each person has $100,000 of self-employment compensation, they can contribute the entire amount up to the overall limit as an after-tax contribution. $69,000 for 2024, $70,000 for 2025, then move it over to the respective Roth solo 401k or Roth IRA accounts where it has that potential for tax-free growth. All right, thank you so much. We'll spend just a couple moments on the deadline. Just pause to say, if you are finding this to be helpful, please like. That helps us get the word out to other entrepreneurs like you, like on YouTube, like on LinkedIn, like on Twitter, wherever you're on. Please subscribe as well so you'll get notifications of when we go live. So we, of course, really appreciate the chance to discuss these topics. If you do have any questions, don't hesitate to chat it over. We'd love to field questions. But in the meantime, we'll just talk about the deadline to make contributions. So this time of year, that's a common question. So we'll spend a few moments on that. So your ability to make contributions, or I should say the deadline to make contributions, is a function of how your business is taxed. In other words, it's driven by the business tax return deadline. So for those self-employed individuals whose business is taxed as a sole proprietor, or an LLC taxed as a sole proprietor, with income reported on Schedule C of your 1040, if you set up a plan before the end of last year, you signed up with us, or maybe you set up a basic plan like at a discount brokerage, and now you want to upgrade to our plan to take advantage of the ability to make mega backdoor Roth contributions, you would have preserved the ability by setting up the plan before the end of last year to make all types of contributions, whether employee, employer, or voluntary after-tax by your business tax return deadline, including any timely filed extension. So if you do file an extension on a timely basis for your 1040, that'll give you in that situation until October 15th to make all types of contributions for 2024. Now, if you didn't set up a plan before the end of last year and your business is taxed as a sole proprietor, you could still set up a plan in 2025 and make all types of contributions for 2024, including employee, employer, and voluntary after-tax, but you would have to make that employee contribution by April 15th. So obviously there's very limited time left to do that. But if you're only interested in making employer and or voluntary after-tax contributions for 2024, and your business is taxed as a sole proprietorship, and you didn't set up a plan before the end of last year, as long as you file an extension on a timely basis for your 1040, that'll give you until the extended tax return deadline, October 15th, in other words, of this year to set up a plan and make both employer and or voluntary after-tax contributions for 2024 by that extended tax return deadline. Now, for other business types, could be a partnership, could be an S Corp, could be a C Corp. If you didn't set up a plan with us or set up a basic plan somewhere else that now you want to upgrade to our plan before the end of last year, then it's too late to set up a plan now and make employee contributions for 2024. But there's still time to set up a plan here in 2025 and at least make employer or voluntary after-tax contributions, provided that you set up the plan in time to make those employer or voluntary after-tax contributions for 2024 by your 2024 business tax return deadline, including any timely filed extension. So if your business is taxed as an S Corp or a partnership, if you filed an extension for your 1065 in the case of a partnership, or your 1120S in the case of an S Corp, that would give you until September 15th to set up a plan and make at least employer and or voluntary after-tax contributions for 2024 by that September 15th deadline, by that extension deadline for your taxes. Hopefully that makes sense. Appreciate all the great participation. Please continue to participate. We host daily webinars. It's always free to join. All are welcome. It's not just limited to clients. So if you're thinking about setting up a plan or you're just trying to learn about it, or maybe you have customers, everyone's welcome. It's always free to join. You can also join us on our community, mysolo401k.net/my community. Totally free to join. We've got over 30,000 members. So we've got vibrant forums on there. We've got a library of videos and webinars. So we do appreciate the participation. Thank you so much. Again, if you're finding it helpful, please like. It's a great way to participate. Of course, there's a growing number of self-employed individuals, and it's great to get this information out to them. So it's just simply liking helps to get that information out to them. So again, we appreciate it. Until next time, everybody, thank you so much.